Hello and welcome to a brand new show, Smart Money, a show that is for you and about you. We've been inundated with queries about the markets and stocks, so we decided to come out with a special show where we feature marquee guests with decades of experience. But the special guest on the show is you, yes, our viewers. We'll be taking up all of your questions right here, right now. So keep those tweets coming, guys. Just hashtag AskCNBC TV18 and keep those queries flowing. Decode, demystify, debunk. That's the motto of the show. Of course, what we've also done is curated all of your queries, and we're going to give you the top trending queries of the week. On the show today, here's what's lined up. First up, gold hits a record high. Is there more to go? And what's the next safe haven? We find out. A COVID vaccine is likely in the next 6 months. How to invest in the post-COVID vaccine world, and what are the big themes? So many young retail investors are joining the party. How does a young investor plan his or her finances? And e-commerce, the next big play for India. Are ETFs an interesting investment opportunity, or should you stick to plain vanilla mutual funds? All of that and more will be discussed with our first guest on the show, a man with over 2 decades of experience in the equity markets. Sunil Singhania, the founder of Abakkus Investment Managers, joins us now. Sunil, thanks so much for joining us on the show and being our first guest here. You know, I'm going to just start by asking you to not wear your investment guru hat, but wear the hat of a teacher. We have so many queries that are coming in from so many young people today. So before that, if you had to give them one pearl of wisdom with regards to investments, what would it be?
So I think, one thing is very clear, we are all students here. So, even if someone has 20 years of experience or 30 years of experience or 3 years, I think every day we learn something. And I think that is something which every budding professional has to keep in mind. You will never learn it all. And I think that would be something which I would urge every investor that just keep on reading and keep on learning.
Okay, keep on reading and keep on learning. And you know what? We have so many people who've written to us, who've given us their queries. So let's get started very quickly. First up, we have the big themes that we get in with our viewers. We have a query coming in from Mr. Chandresh Lodhia, and he's been an avid follower on Instagram, on Twitter. He's one of those millennials who follows us on our digital platform. So let's chat with him. Chandresh, hi, go ahead. What's your question?
I had a question, like everyone is talking about COVID-proof and anti-fragile portfolio. But considering that the vaccine arrives in a year's time, what stocks should we look for in the post-COVID world, say for a horizon of 2 years or so? Thank you.
All right, thanks Chandresh for that question. That's interesting, right? I mean, everyone generally, Sunil, talks about what do you buy during the COVID era. But if there's a vaccine coming in the next 6 months, I need to prepare myself for that. What is the right answer to that?
So I think, last 3-4 months have been very eventful. This COVID has come in. It was the first time in our life that we encountered anything like this where the whole countries, after countries were shut down completely. So I think there have been few things which have taken, a beating in the near term. Some of them will revive. And there have been few instances where this has come out as an opportunity. So we are all in the midst of a massive bull run in the pharma space. We are already seeing, despite the prices having doubled, the results are coming in fantastic. And obviously that is going to be a long-lasting, I would say, a sector where there will be opportunities. On the other hand, there have been some sectors which have been hit in the near term. As I said, multiplexes, travel, tourism, retail. I think some of these sectors will definitely bounce back because human beings are human beings. And, if you look at Europe and if you look at US, there has been quite a rapid sort of a bounce back from the lows of March. And in fact, in some of the countries, you are now back to normalcy. And that would include a lot of, obviously retail consumption items. But at the same time, there are some things which have changed dramatically. So our habits have changed. Actually, if you, Sonia, go back post demonetization, which was 2-3 years back, Indians started to use less cash and more digital form of money. So whether it was online money transactions like Paytm and other things, or even debit and credit card. And that habit stuck even after demonetization because, we started using a lot of those things. I think even in the case of COVID, there have been some habits which have stuck with us, whether it is shopping online and a lot of other things. And I think in some cases, these habits will mean that the business proposition for some of the earlier sectors might be impacted and some of the new sectors might come in. So I would say if human beings are human beings, obviously some things which we can't live without, which is, obviously shopping, traveling, will come back. But maybe, it will be more leisure travel, it will be shopping, maybe going to the malls or online. Shopping will be there. So it's going to be a little bit tricky. I would say that we have to take it as it comes.
Okay, well, you said the right word, shopping. I can't wait when the next time will be I can go to a mall and shop my heart out. I mean, there's only this much retail therapy you can do online, right? But be that as it may, we're getting a lot of queries coming in right here, right now. So I have one coming in from a young woman. So let me just try and get my director to dial her right into our show live. Navya Menon is writing into us. So if we can just get her on the show.
Hi, so I'm a student and my query was that I am new to the stock market. I don't really know much about it, and also I'm not earning, so I don't really want to keep my parents' money at risk. And we know that all these blue chip companies like Reliance, Infosys, TCS are above 1,000 per share. So since I'm not earning and my budget to invest in the stock market is not more than 5,000, which stock should I pick? That is my query.
Okay, Navya, thanks for that. First of all, Sunil, we should congratulate her for thinking about investments so early on in her life, right? When I was that young, I only thought of spending my money and not really investing it. But her point is valid. I mean, she has a small sum. Many of these blue chips are really expensive. What is your advice to her?
So, as you rightly said, it's great because the earlier you start investing, the bigger is the compounding effect. And also when you're young, you have a higher risk-taking ability and capacity than when you age. So I think, again, congratulations from my side also. If you have a small sum of money, it is obviously going to be very difficult. And having a one stock or a two stock portfolio will be fraught with risks because, there can be a company-specific event, there can be a sector-specific event, which can impact the performance of that particular stock or a couple of stocks. So I would suggest that if you have a small sum of money, you should go through the mutual fund route or an ETF route. Because even with 5,000, you would be able to buy a good basket of 20 stocks, which on your own, it would be very difficult or maybe even impossible, because you have stocks which are 2,000-3,000 rupees per stock. So even if you buy one stock, it will be 2,000 rupees gone. But if you are able to invest in a mutual fund or an ETF, this 5,000 rupees will give you a great diversification. So I would suggest that do an SIP. And that would be the best way of letting your money grow.
Okay, in any case, most of these youngsters, these millennials have jobs to do. They have, many of them are young, they have houses to run. So I guess leave all the fund managing to professional fund managers, right? All right, we have another query coming in from Siddhant Gupta, and he's actually one of the winners of our contest that we ran on Twitter and Instagram last week. So Siddhant, congratulations to you. Go ahead, ask your question.
The market is trading at a PE of 29 plus. Historically, a PE of 28 and 29 have always been followed by a fall. Do you think we can see a fall in the medium term, or the rally we have seen can turn out to be a bear market rally?
Okay, well, if I got that right, he's worried about valuations at this time because every time the market trades at such expensive valuations, something or the other happens and there's this big crash. You think this time is going to be different?
So it is very logical because the PE ratio obviously is the easiest ratio which gives good indications. It's not the only ratio which we should follow, but it gives you a reasonably good indication of how cheap or expensive the market is. So the FY21 earnings are going to be one of the most challenging we have seen in the recent past, and largely because the first quarter for most of the companies was anywhere between 50% to 90% a washout. And to that extent, the FY21, which is the March 21 earnings, are going to be at least 20-25% lower than the March 20 earnings. And therefore, the PE ratio at 28-29 seems to be very, very high. However, if you just go one year forward, which is FY22, the Nifty is trading at a PE of roughly 18.5 times, which is not cheap, but which is not very expensive also. The other thing to note is that the composition of Nifty has changed dramatically over the last few years. So, we have now a lot of pharma companies, we have a lot of consumer companies like Nestle, Britannia, Hindustan Lever. And also we have a lot of these high PE stocks, unlike the earlier Nifty, which also had some low PE stocks, and therefore the PE of Nifty used to be, looking low. So given all this, I would say that we are at a fair valuation. I won't say that we are cheap, but I won't say that we are expensive, and we are definitely not in a frothy kind of a scenario. So now going forward, if we still believe that this interest rate reduction or lowering of interest rates is a structural sort of a phenomena, then I would say that there is still some way to go.
Okay, well, Sunil, I have many personal questions for you as well as to where did your journey start? What kind of books do you advise young investors to read? But all that lined up on the other side of the break. So guys, don't go anywhere. When we come back, we'll focus on the top trending queries and lots more coming up. Stay tuned. Welcome back to our brand new offering, Smart Money. On popular demand, this is a show where we talk about all of your queries, all of your questions in your mind about investments, and we get a big guest to tell us what we should be doing. So in this segment, we're going to talk about the theme of the week. Now, we've curated all of your queries and we found out that a lot of you are asking us questions on the e-commerce theme. So we're going to talk about that. Work from home, online shopping, digital payments have also seen a multi-fold increase due to the lockdown. Sunil Singhania is our guest, so let's go straight to him. Sunil, you've been telling me about how this could be the next big play for the Indian economy and for equities as well. But as an investor, how does one really capitalize on this?
So, Sonia, we are all, experiencing it on a daily basis, our own habits. You mentioned work from home. In fact, even before that, we were all getting exposed to this concept of online shopping. The Amazons and the Flipkarts and so many big baskets and so many others were already there. As I mentioned earlier, this journey or this move has only got accelerated with this lockdown. When shops were closed, when people were a little bit scared of moving out and going in for physical shopping, I think this move towards everything to do online has accelerated a lot. Unfortunately, in India, we don't have too many listed companies, and I would say that is an unfortunate part. I think one aspect where I would say we are very liberal is the government allowing almost all the overseas guys or overseas companies to set up 100% subsidiaries here. So WhatsApp has the value because of Indians and Indians using it, but we can't invest in that, and so is Amazon and so on and so forth. So, we are left with a small bunch of companies. Obviously, we have the mother of all, the Jio platform, which had a massive, deal, and the stock has already shown, the benefit of that. But other than that, I think telecom comes out to be a good play. We are all using data massively, whether it is work from home, whether it is, entertainment at home. And I think that will continue. We still don't have any direct OTT platforms, maybe indirect plays listed, but that again would be a big theme as we move forward. There are a few companies which have exposure to online gaming, not too many, but there are a few. I think there will be opportunities there. And I would say that, as we move forward, we are very sure that more and more companies would look at listing in Indian markets. There are a few good mutual funds who have a part exposure to some of these global, e-commerce and IT companies. I think those funds can also be looked at. I would say that it's still early days. We should not get disappointed that we have missed the bus. We are a country of 1.3 billion people. Our online penetration was less than 5% before the COVID hit us. It's now moved to 20%. If you look at US and China, we are way, way behind. And I would say that as we move forward, there would be more and more opportunities which will come our way in this space.
Okay, more opportunities in the e-commerce space. That was the big theme of the week. The other query that we got inundated with was on gold. And we all know that the yellow metal has had a dream run. It scaled a fresh peak. In India, it hit the 53,000 mark. Who would have thought, right? So Karthik Dattani has written into us. We tried to get him on board on our show, but we couldn't for now. So I'm going to read out his query. Gold is at a record, but what is the next safe haven bet? Sunil, this question to you. I mean, in hindsight, our mothers perhaps were the best fund managers when they told us to buy gold every Akshaya Tritiya, right? But what is your own view here? Do you see more of a rally in gold? And if not, what's the next safe haven one can invest into?
So, in fact, I had also tweeted a few months back that women in India are the best fund managers and they have left all of us behind. So every year we come on TV and we talk about how equity is the best investment and how gold is the worst investment. And, time and again we have proven wrong. I think what has happened is that this whole surge in global liquidity has led to obviously, concerns over how it is going to end. And whenever there is volatility, whenever there is concern about the future, gold as a safe haven does well. And now with all this funds also investing in precious metals, there is a cycle of gold doing well, and therefore there is a lot of investors who want to invest in it through the ETF route also, and then there is more demand as far as gold is concerned. The one thing in favor of gold is that there is a finite quantity of gold which can be mined every year, and that is not going to increase. So I think you have a limited supply and a lot of money chasing it. So at this point of time, it looks to be in good space. From an Indian investor's perspective, Indian investors have also benefited because rupee vis-a-vis dollar appreciates on an average 3 to 4% every year. And because gold is an international sort of a commodity valued in dollar terms, as a rupee investor, you also tend to benefit out of it. In terms of going forward, I frankly don't know what a safe haven is. Frankly, my view is that you invest in any product to generate returns, not to lose money, So obviously asset allocation is very important, but I would say that for wealth creation, you have to have generating assets, and there I would say equity stands out as the best.
Okay, well, we've heard that one before, right? We have a lot of queries coming in, so let me try and dial in Tirush Dikshit. He's written in to us. He has a query, very interesting one actually. Tirush, what would you want to know from our guest?
So my question was, how to calculate the intrinsic value and what are bargain issues? So during these volatile times, how can we calculate these bargain issues and intrinsic value of a particular stock or funds or bonds?
Okay, Sunil, I think you should have a separate class, a half-an-hour class on how to calculate the intrinsic value. But in any case, for young, curious investors, what would your answer be?
So, as you rightly said, it's a big discussion point. But there are various methods of the traditional methods of calculating intrinsic value. You have PE, you have the price earnings to growth ratio. You also have a DCF model, and then there are various other theories like replacement cost and all. I think these work for brick and mortar companies, where you have a base value of the business, and then based on the growth, you will give it a premium. because if a company keeps on growing at 15-20%, then the value after 5 years will be significantly higher than what it is today. However, some of the new age companies will never be valued on these traditional matrices, and I think that is where a lot of so-called value or traditional investors are not able to invest in them. So if you were to say 10 years back that Netflix would be where it is today, I would say that 99.9% of the investors would not believe in it. But there would be some investors who would say that this is a sort of a top-down big opportunity. And the way of investing there is very different. These are very high-risk investment bets. You take a big call that, today out of 130 crore people, say less than 10 lakh people are on an OTT platform. And going by the trend, whether it's in the US or some other place, you might have this number going 20, 30x. And that is how you basically take a calculated bet on that. Or, something like Tesla, again, you're taking a bet that today less than 1% of the cars are EVs.
Yeah.
But, in the next 5 years, maybe 10, 20, 30% of the cars can be an EVs. So I think the new age businesses are very difficult to value on a traditional matrices, but the brick and mortar, you have a lot of ratios which you can use.
Okay, we have one more query coming in, Sunil. Before our show ends, I just want to get the last theme going for today. Are ETFs better investment opportunities versus mutual funds? Vineet, who's an avid watcher of CNBC TV18 and follows us on almost all our social media platforms, joins in. So, Vineet, thanks for being with us. Tell us your question.
Good evening, Singhania ji. This is Vineet here from Pune. So, my question to you is pertaining to ETF. I have been investing into mutual fund for quite some time, being a long-term investor. However, the return profile has pretty much not been great. I really wanted your view on what ETF as an investment tool, which seems to be more passive mode. However, this is being tracked as a greater tool for nifty returns tracking. What would be your view on this, sir?
Okay, Vineet, thanks a lot for your question, and that's a beautiful Ganpati that you have on your wall. I mean, really stunning to see. So thanks a lot for that. Sunil, over to you. What would your suggestion be to Vineet?
Sure. So the basic difference between an ETF and a mutual fund is that ETF is passively managed and a mutual fund is actively managed. And therefore, for any, I would say for a actively managed mutual fund to score over an ETF, they will have to generate an excess return. However, last few years, particularly on the large cap space, it has become very, very difficult to generate that additional alpha over the ETF or over the index. And because there is a big difference in the fee structure of an ETF vis-a-vis an actively traded mutual fund, I would say that if you're a large cap investor who want to just get sort of nifty kind of returns, then an ETF is much better. However, there is a possibility of generating alpha if you go down the market cap range. If you're investing in a broader sort of a market where you're looking at more non-nifty or maybe more mid cap and small cap, I think there are a lot of good quality mutual funds and asset managers are able to generate that alpha. So maybe in those categories, you can use an actively managed.
I'm sorry to cut you off there. We've actually run out of time. But before we end the show, Sunil, my question to you. Everyone's asked their questions. My question. The one book that you would advise us to read to become, a sound investor like you, and the one Twitter handle that you love to follow.
So, I'll just give you a perspective. There are a lot of books, but I like autobiographies. And I'll just give you my rationale. Any successful person, has an ambition or a sort of, wants to write a book. And the book contains the best experiences and a very, very fair assessment of what has worked and what has not worked for that person. And I always tell, whoever I meet that for 500 rupees, you're getting 25 years of experience in an autobiography. So I would say read autobiographies of every successful person. You'll get a lot of insights into it. In terms of Twitter handle, I often can't sort of work out, but I enjoy Elon Musk tweets because they are very different. including the one which you tweeted yesterday.
Absolutely, top of mind, right? They're more entertaining than anything else. Sunil, always a pleasure. Thank you so much for guiding us, for teaching us, and for being a part of our first episode of a brand new offering, Smart Money. With that, guys, it's curtains down on this very new offering for you. But don't worry, every Friday at 3:30 p.m., we'll be back right here at the same time. Until then, you guys have a good weekend.